Hello everyone, my name is Farhan and today you will solve question number 1 from 2022 paper 2 past exam. In this question, you will prepare the statement of financial performance, which is also known as the income or the profit and loss statement, and you will also prepare the statement of financial position. So the question is going to be on the left hand side of your screen, and on the right hand side you will see all the workings, which I'll explain step by step. Make sure to focus and follow through the entire content for an excellent understanding, and I promise you'll get a lot of value from this video. So with that being said, let's begin. So the following balances were extracted from the books of Element PT Limited on 31 August 2022. So here you can see we are given a list of balances for various items such as assets, liabilities, revenue, income, and expenses. Then you're given some additional information, as you can see, and the first requirement of the question is to prepare the statement of financial performance for the year ended 31 August 2022, also known as the income and the profit and loss statement. So let's start with the first additional information that we are given. So fixtures and fittings are to be depreciated at 10% per annum using the straight line method, assuming a scrap value of $30,000. Now, 10% per annum simply means that the useful life of fixtures and fittings is 10 years. Because if you are using the straight line method and every year you consume 10% of the economic benefits that comes with purchasing the fixtures and fittings, then you can use all the economic benefits for a total of 10 years. Now, how do you find the depreciation on an annual basis using the straight line method? So it is pretty straightforward. So you take the given percentage and then multiply it with the difference between the cost and the scrap value. Now, the percentage is given to us as 10 on an annual basis. The original cost is $270,000. So where did we get this original cost from? So you can check the first line of the balance that we are given, which is $270,000 for fixtures and fittings. And then you're subtracting the scrap value of $30,000, which is given in the additional information. So once you find the difference, which is $240,000, you multiply 10%, and altogether the depreciation for the year is $24,000. Okay. Now, what is the meaning of scrap value? Now, the scrap value refers to the estimated selling price that you can expect to get after the end of the useful life for the fixtures and fittings, which means after the fixtures and fittings were used for 10 years, if you were to get rid of them or sell them, you would be able to sell them at $30,000, which is also known as the scrap value. Now, I have some more questions for you. So how about the journal entry? Now, the journal entry for any depreciation that we incur in our business, you always debit the depreciation expense, which in this case is to depreciate the fixtures and fittings. So depreciation expense for fixtures and fittings by $24,000, and the credit entry would be accumulated depreciation specifically for fixtures and fittings, and that is also $24,000. Now, how does this work with the financial statements that we have, such as the income statement or the statement of financial performance? Now, in the income statement or the statement of financial performance, we have to record the depreciation expense or the depreciation for fixtures and fittings as $24,000. And then in the balance sheet, which is the statement of financial position, you need to show the accumulated depreciation of fixtures and fittings. So what would be the accumulated depreciation for fixtures and fittings in the balance sheet? Now, the accumulated depreciation simply means the total depreciation we have so far. So the balance sheet will be prepared at the end of 31 August 2022, which is the end of the financial year. So when you want to find the accumulated depreciation, you take the previous depreciation that you have from the list of balances given, and that is $48,000, and then add with the $24,000 in depreciation for the current financial year. So altogether in the balance sheet, you will show the accumulated depreciation of $72,000 for fixtures and fittings. Okay, so let's move to the second additional information now. Now, the second information says motor vehicles are to be depreciated at 30% per annum using the reducing balance method. So when you're working with the reducing balance method and you want to find the depreciation, you apply the percentage that we're given in the question, you multiply that with the net book value. So what is the net book value, which is also known as the carrying amount? Now, the net book value at any point in time can be calculated by taking the original cost of the asset and then subtracting the accumulated depreciation. Now, the original cost for the motor vehicles is $125,000. As you can see, it's given here, motor vehicles at cost to be $125,000. And then the accumulated depreciation is $63,750, which is also what you can see is given here for motor vehicles. So once you subtract the accumulated depreciation from the cost, which is $125,000 minus $63,750, you get a net book value of $61,250. Now, this net book value is what we have included here. So when you multiply the percentage of 30, which is given in the question, with the net book value of $61,250, you get the depreciation as $18,375. So in the income statement, you will show the depreciation of motor vehicles to be $18,375, which is also the statement of financial performance. So under other expenses, you need to show this depreciation of motor vehicles as $18,375. And in the statement of financial position, which is the balance sheet, you will show the accumulated depreciation for motor vehicles, which is the total depreciation that will be the addition of this 18,375 for the current financial year ending 31 August 2022 and the previous depreciation of 63,750. Okay, so if that is clear, which I believe so, let's move to the third additional information. Okay, so the third information says that at 31 August 2022, commission income $1,200 had been received in advance. Okay. Always remember that anytime you receive income in advance, we have to classify that as a current liability. Now, the reason this is a current liability is because we are receiving the cash, but we are yet to fulfill our obligation in terms of delivering the service or the product. So what's happening here is that we have got $1,200 in cash in advance, which relates to commission income. But because we haven't fulfilled our service or our obligation in selling the product yet, we cannot call this as an income that we have actually earned. All right. So that is why this falls within the definition of a current liability, which is a present obligation for the business, and the business needs to pay this off within the next 12 months. Now, under the accrual basis assumption, if you want to calculate the profit, how do we do that? So we start with the revenues earned, and then we subtract the expenses incurred, all right? Because this $1,200 in commission income received in advance does not fall into the definition of revenues that have actually been earned, what do we have to do? In the income statement, when you record the commission income, you have to reduce the commission income by $1,200. So look into the question on the left-hand side, you will see the commission income originally was given as $28,200, and I'm subtracting $1,200 from that because this $1,200 is not earned income. This $1,200 falls under the definition of a current liability and must be shown as part of the current liability. But in the income statement, when you add the other income to the gross profit for commission income, you must subtract $1,200 from the original balance of $28,200 that is given to us. Okay? So as you can see here, in summary, in the income statement or the statement of financial performance, reduce the commission income by $1,200. And then in the statement of financial position or the balance sheet, within the current liabilities section, you need to show commission income received in advance of $1,200. Okay, so let's move on to the next one. So rent and rates of $500 was prepaid. Now, prepaid rent and rates of $500 refers to a current asset. Why is this a current asset? We have paid for expenses that we will consume at some point in time in the future, and we have paid for these expenses in advance. So every time you make an advance payment for an expense, we call that a current asset, which in this case is the prepaid rent and rates expense. Now, how should we treat this in the financial statements? When you prepare the statement of financial position or the balance sheet, you increase the assets, specifically the current assets, and within the current assets section, you show prepaid rent expense of $500. And when you prepare the income statement, you have to reduce your expenses for rent, because rent and rates expense is originally given to us as 10,750, as you can see on the left hand side in the question. And you have to subtract 500, because 500 out of this 10,750 refers to an advance payment, which is expense that we haven't incurred or consumed any economic benefit yet. Okay, so this $500 is to be reported separately as current asset when you prepare the statement of financial position. And when you prepare the income statement, you show rent and rates expense of 10,750 minus 500, which is $10,250. That is what you will report in the statement of financial performance or the income statement. Okay, so I'll just write statement of financial performance quickly here. Okay, so I believe that is clear. So let's move on to the next one. So wages and salaries of $870 were owing. Okay, so this refers to wages that we haven't paid yet. So wages payable or accrued wages. So they are synonymous to each other. They mean the same thing. And that is $870, and we classify this as a current liability. This is because we have utilized the energy, the effort, and the time that our staff or our employees have put into our business. But we are yet to pay them using cash, which means this is a wages that is payable. So this is referring to a current liability. So when you prepare the balance sheet within the current liability section, you need to show wages payable of $870. Okay. Now, because we have used the energy, time, and effort from our staff and our employees, this is necessarily referring to as expense that we have consumed or expense that we have incurred. All right. So what happens is when you prepare the other expenses section in the statement of financial performance, you need to show total salaries and wages payable as $63,000 plus an additional $870 that we still owe them. So altogether in the income statement, you will show $63,870. Okay. So the summary of this is to increase the current liability, mainly the wages payable in the statement of financial position, and also to increase the expenses for salaries and wages, which is basically the total of $63,000 plus an additional $870 when you prepare the statement of financial performance. Okay. All right. So let's move to the next one, number 4. It was decided that 5% of the trade receivables were unlikely to be collectible. All right. So here what we're doing is calculating the allowance for impairment of trade receivables at the end of 31 August 2022. Now, how do we calculate this allowance for impairment of trade receivables? We take the given percentage and multiply with the trade receivables. So the given percentage is 5, as you saw, and the trade receivables we have is $28,480, which is what you can see here. So trade receivables of $28,480. So once you do this calculation, you get allowance for impairment of trade receivables at 31 August 2022 to be $1,424. Now, my question to you is, what is the meaning of allowance for impairment of trade receivables? So allowance for impairment of trade receivables simply refers to the possibility of amounts that we expect to not receive from these credit customers. Now, the trade receivables are the credit customers of the business. So these are the people to whom we have sold items or inventory or goods on credit, right? Now, based on our past experiences of running our businesses, we expect that 5% of these credit customers are unlikely to make their payment to us, that they owe us, okay? So the amount in this case is $1,424 that we expect to not receive, which is known as the allowance for impairment of trade receivables, and this is the amount at 31 August 2022. Now, let's check the allowance for impairment of trade receivables that we're given in the list of balances here. So this is 1,050. So this balance that's given here mainly refers to the opening balance we had at 1 September 2021 or the closing balance from the previous financial year ending 31 August 2021. So in the previous financial year, we had $1,050 as the allowance for impairment of trade receivables. But in the current financial year, you've got $1,424, which means that there is an increase in this allowance, right? And this increase in allowance for impairment of trade receivables is what we also classify as an impairment loss, which is an expense. So what is that amount? That amount is the difference between the new value and the old value. So 1424 minus 1050, which is $374. So this $374 is what we call the impairment loss, and this is to be shown as part of the other expense when you prepare the statement of financial performance. And at the same time, we understand that if you want to find the ending allowance, if you want to calculate the net trade receivables, which you are going to show in your statement of financial position, you use the ending allowance that we had calculated ourselves, and that is $1,424. Okay, so this $1,424 is part of the statement of financial position or the balance sheet, and this $374 is the impairment loss reported as part of other expenses when you prepare the statement of financial performance. Okay, so let's move to point number 5. The company declared a dividend of 10 cents per share. This will be paid on 1 December 2022. All right, so you see how the question clearly mentions that this is dividend declared. All right, so any dividend that has been declared, we can understand that this is declared at end of 31 August 2022, but this is going to be paid in the next financial year on 1 December 2022. Okay, now we call this a current liability, and let's calculate the amount for dividend that we expect to pay to our shareholders. So it is 10 cents, which is $0.10, multiplied by 75,000 shares. As the question mentions, $0.10 per share. So how many shares we have got? 75,000. And this number is what I've got from here, as you can see. Issued share capital, 75,000 ordinary shares. So the dividend payable is going to be 0.10 multiplied by 75,000, which is $7,500. So why is this a current liability? Why a current liability? Because the definition of a current liability simply means present obligation for a business that is expected to be repaid within the next 12 months, right? We understand, based on what the question explicitly mentions in point number 5, that this dividend is going to be paid on 1 December 2022. So if this dividend is paid on 1 December 2022, and today we are preparing the financial statements for the year ended 31 August 2022, from 31 August 2022 to 1 December 2022, it's just 3 months ahead. September, October, November. So that is why this falls within the next 12 months and therefore meets the definition or criteria of a current liability. So when you prepare the statement of financial position, within the current liability section, you need to show dividends payable of $7,500. Okay. Now, this dividend is going to reduce our retained earnings by $7,500. And retained earnings simply refers to profits that are reinvested in the next financial year after the dividends are paid. Profits from the current year, which are reinvested in the next financial year after the payment of any dividends to the owners or shareholders of the business. So if you want to find the ending retained earnings at 31st of August 2022, you can calculate that by starting with the opening retained earnings, which is $99,510, which is what we have got from the list of balances given here. As you can see, the retained earnings at 1 September 2021, which refers to the opening balance, plus the profit, which we do not know yet, but we will know after we prepare the statement of financial performance, and then you will subtract the dividends payable. So we will find this balance eventually, and this is to be used as part of the statement of financial position because retained earnings is part of the capital or the equity in the business. Okay, so this goes into the statement of financial position. All right, so let's see what we're doing in terms of the statement of financial performance or the profit and loss statement. So I've already prepared this here, and let me walk you through each and every line. So starting with the formalities, so you write the name of the business, which is Element Proprietary Limited, and you've got statement of financial performance for the year ended 31 August 2022. So I've drawn two columns, and we start with the sales revenue of 438,820, and then we subtract the sales returns of 21,300, and we get net sales revenue of 417,520. So what I recommend is, as you prepare this during your exam, as you select each item, make sure to tick them so that way you know that you have already picked that item. All right. So let's see what's going on. So look into the question on the left hand side of your screen. So we have already selected sales revenue, which is 438,820. You can see here. And we have already selected sales returns, which is $21,300 here. So as you can see, these two numbers have already been utilized here. And that's how we get the net sales revenue of 417,520. Then you subtract the cost of sales, which is $265,900. And the cost of sales simply refers to the cost that we had to pay as the business ourselves when we purchased the inventory from our suppliers. Okay. And that cost of sales is $265,900, which is what you can see here. So let's take that since we have also used that. Okay. Now, once you subtract the cost of sales from the net sales revenue, you get gross profit, and that is $151,620. And then you add other income. So any other income. So in this case, in this question, the only other income we've got is the commission income. And as you remember, $1,200 was received in advance, which is not really an income that we have earned. And based on the accrual basis assumption, we cannot really use this as part of our profit calculation because we didn't really earn it. We just received the cash in advance, but we are yet to fulfill our service or our obligation to deliver the product. Okay. So the commission income here is $28,200 minus $1,200, which is $27,000. So let me quickly take you there where I got this number from. So as you can see, commission income was originally given as $28,200, and then we know $1,200 is received in advance, which we are subtracting. So let's take this as well. Actually, let's highlight the numbers that we have already used, which I believe helps you to better visualize what's really going on. So all these numbers, all this stuff, they have already been used. Okay. All right. So next, you are starting with the other expenses of the business. All right. So let's start with the first additional information we've got. So the only thing that you need to be really worried about, not worried about actually, really be careful of during the exam is not to miss any items. And the way I recommend you start this, as you go through each and every line item, make sure to highlight them or tick them so that way you know you have already used them. Okay. So what we are doing in this case is starting with the first additional information. So the first additional information gave us the calculation for depreciation of fixtures and fittings, which was $24,000. So I'm not going to scroll back up, but I believe you remember this based on our first working we have done today. And then we calculated the depreciation of motor vehicles using the reducing balance method, and that was $18,375. Okay. Then we find the rent and rates expense. So how do we find the rent and rates expense? So originally we are given $10,750, and we have to subtract $500, which are the prepaid rent and rates expense, which refers to a current asset amount or expenses that we have paid in advance, but we really do not have an expense at the moment. So when you prepare the statement of financial performance, you need to subtract this 500 because this is not really part of an expense, but rather a current asset. So altogether, we get 10,250. So check the question on the left-hand side and let's highlight what we have already used. So we have used rent and rates of 10,750 minus 500. Okay. And we have already used the depreciation calculations. So number 1 and number 2 is sort of all done as well. And then we have got wages and salaries based on our adjustments from the additional information. So we started with $63,000, which is the original balance that we were given. And then we are adding $870 as the amount that we owe. So altogether, it's $63,870. So why are we adding $870 here? Because this refers to expenses that we have already incurred or consumed because our employees have already worked for us. but we are yet to pay them. So obviously this needs to be added as part of your expense for an accurate profit calculation. Then we have got utilities expense of 7,800. This does not really have any adjustments, and I've just simply taken it from the list of balances that we're given. So let's highlight the wages and salaries and the utilities expense that we have already used. Okay. All right. So the last thing is the impairment loss and trade receivables, which we calculated ourselves, and that was $374. So the way we calculated this is based on the new allowance for the current financial year, which I believe, let's just go back up, and that was $1,424. And from there, we subtract $1,050 for the previous financial year. And because there is an increase, we classify this as a loss or as an expense. And that is $374. So there is really no other expense to think about. So all you have to do in this case is find the total of everything here, which is $124,669. How do we find the profit for the year now? So if you want to find the profit for the year, you start with the gross profit, then you add the commission income of 27,000, then you subtract the total expenses of 124,669, and you get 53,951 as the profit for the year. We are calling this a profit because this is a positive amount, 53,951. Okay, so I believe that clears any doubt you may have with the statement of financial performance. Now, let's calculate the ending retained earnings balance. Let's go back up, given that the profit now is 53,951. So we are here. So if you want to find the ending retained earnings balance, we start with the opening of 99,510, and then you add the profit of 53,951. Let me just double check this, 53,951 minus the dividend payable of 7,500. Okay, so let's see how much we've got. I think $145,961 is the ending retained earnings at 31 August 2022. Okay, I think that's all done for the statement of financial performance. Now let's look into the balance sheet, which is also known as the statement of financial position. So starting with the formalities, you need to write the Element Proprietary Limited statement of financial position as of 31 August 2022, and then you start with 3 columns. So to begin with, we start with the assets, and the first category of assets we look into is the non-current assets. So the non-current assets have 3 components, which are the original cost, the accumulated depreciation, which is also known as the total depreciation, and then the net book value. So the net book value is calculated as the difference between the original cost and the accumulated depreciation. All right. So let's start with the first non-current asset that we have got, which is fixtures and fittings. All right. So fixtures and fittings, original cost is $270,000, which is what we have taken from the very first line here. And the accumulated depreciation is $72,000. Because in the previous year, we had 48,000, and in the current financial year, based on our calculations for depreciation in the first additional information, which you have seen, we had 24,000. So altogether, this 2 added gives us 72,000. So how do we find the net book value? So the net book value, as I've disclosed before, cost minus accumulated depreciation. So 270,000 minus 72,000, and that is 198,000. Now the next non-current asset is the motor vehicles. So motor vehicles have an original cost of $125,000, as you can see here, and the accumulated depreciation of $82,125 is basically the total of $63,750 from the last financial year, minus the plus the $18,375 for the current financial year. Right? That's how you get $82,125. So the net book value, cost minus the total depreciation, and that is $42,875. So the total non-current assets, you can just simply calculate the net book value because that is what we use as part of our calculations moving forward. And that is the total of $198,000 plus $42,875, which gives us $240,875 as the total non-current assets net book value. Next, we have got the current assets. And under the current assets, let's see what we have got. But before that, why do not we shade all this? Because we have used all of this, right? So you know that you have used majority of the question. So the first current asset is inventory. And you can see here, inventory is given as $42,500. Why is inventory a current asset? Because if you are a business, you would want to sell this inventory as quickly as possible. That is definitely in the next 12 months if you want to survive, right? So the reason we call this a current asset is because we want to get rid of inventory as quickly as possible. And this is also a current asset because when we sell this inventory, we expect to get some money, mainly profit, because when we sell it for high than the cost that we paid to purchase it. Okay. So inventory is $42,500. Then we have prepaid rent expense based on the additional information, and that is $500. The reason this is a current asset is because we have paid for this in advance, but we still haven't used this expense yet, which means the economic benefit with this prepaid rent still exists and therefore falls under the definition of a current asset. Then you've got the cash at bank of 11,900. This is given to us straight away here, which is also the debit balance. Always be sure to check whether this is a debit or a credit balance, because when it's a debit balance, that's when we can call this a current asset, because that means that we have got money in the bank account. But if it is a credit balance, that refers to a bank overdraft, which means you do not have any money in the bank account. Rather, you owe the bank money, and therefore this won't be classified as a current asset anymore, but a current liability. Okay? But in this case, it is an asset which we confidently say based on the debit that's mentioned here. So the cash at bank is 11,900 here. And then the only thing left with is the trade receivables. So this is the gross amount of trade receivables, which is 28,480 taken from here. And then you subtract the allowance for impairment for the current financial year, the ending calculations we did, which was 1,424. That gives us 27,056 as the net trade receivables, which is actually the current asset. So altogether, you add all these current assets together, you get a total of 81,956. Okay. So total current assets of 81,956 added with the total of non-current assets of 240,875 gives total assets of $322,831. Okay. All right. So let's highlight the trade receivables that we have already used, the inventory that we have used, the cash at bank we have used. And yeah, as you can see, most of the stuff have been used already. So next we have got the equity and liabilities. Now, when we prepare the balance sheet or the statement of financial position, essentially we're trying to fulfill the fundamental accounting equation, which is the basis of every accounting problem that exists. And that equation is the assets equal to the total of equity and liabilities. Okay, so we have got the total of assets at the moment, which is $322,831. Now we need to prepare the equity and the liability section separately, and we need to make sure that when those are added, that gives the same amount as the total assets, and that is $322,831. So let's start with the first equity that we have got, which is issued share capital, and that is $150,000 based on what we are given here straight away. We do not really have any adjustments in this case because we did not contribute, we do not have any additional share capital that was issued or cash that was received from new shareholders and new owners. Then we have the ending retained earnings of $145,961. So ending retained earnings is part of your equity because equity essentially means the capital that is available for investment within the business in a given financial year. So all the retained earnings after the dividends that we expect to pay have been taken off is basically reinvested. All right. So previous year profits after any dividends are paid are reinvested. And that amount altogether is $145,961 here, if you remember from our workings from before. So let me just quickly take you here. And you can see ending retained earnings. We started with the opening balance of $99,510. Then we added the profit of $53,951. And then we subtract the dividend payable of 7,500, and altogether we get $145,961 as the ending retained earnings available for reinvestment in the next financial year, and therefore this is what goes as part of equity. So let's go to the statement of financial position. So within the equity section, you've got issued share capital and then retained earnings of 145,961. So you add the total equity, which gives you 295,961. Okay. Next, we've got the current liabilities. In this question, we do not really have any non-current liabilities because in most cases, the non-current liabilities you will come across are the back loans. Okay, which we do not really have any. So therefore, we do not have to worry about that. So starting with the current liabilities, the first thing is the commission received in advance of $1,200. This is a current liability as we have discussed before because we have received the cash, but we are yet to fulfill our obligation, which is to do with delivering the service of the product. Then you've got the wages that we haven't paid to our staff yet, which is known as wages payable, and that is $870. Then you've got dividends payable of $7,500. The reason we are calling this a dividend payable is because the question explicitly mentions that the company declared a dividend, right? The company didn't pay the dividend, it declared the dividend, and the dividend will be paid later in the next financial year on 1 December 2022. Then you've got trade payables of 70,300, which is basically what I've taken from the list of balances that we have been given here. And therefore, we can just highlight this because this has already been included. So is the retained earnings and so is the issued share capital. So that means all the information has been taken care of and incorporated as part of our financial statements and included as part of our workings. So what do we do now? We add the total of all the current liabilities we have got, starting with the commission received in advance and ending with the trade payables, which gives us a total of $26,870. Okay. This total for current liabilities is then added to the total of equity, which is $295,961, and you get total of $322,831 as the total for equity and liabilities. And that's how you know your math is correct, because assets equal to equity plus liabilities, which is the basis of all accounting problems that you come across in life. Okay, so I believe you found a lot of value in this content. That's all for today's lesson. If you need help with any other topics and you would like me to make videos on and discuss any complications that are involved, make sure to post them down in the comments below. Also, subscribe to this channel, share this video with your friends because the exams are coming up soon and I want you all to ace your exams and do well. So with that being said, let's end today's lesson and I'll see you in the next lesson.